We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Josh Cantwell of Freeland Ventures out of Cleveland, Ohio. Josh, how are you today?
I'm doing good, Casey. I got my pot of coffee in me and a workout, and we're talking real estate, so it's been a great morning.
Man, that's kind of like all of the musts in life, I guess, right? Coffee, workout, and real estate. So
That's
anyway,
right.
you and I were talking a little bit before the show, and we decided to go ahead and jump in and get recording so that we wouldn't just have to repeat exactly what we were talking about, because
Right.
pretty much everything that the questions that I have, I know are a lot of the same questions that our listeners have, and a lot of the same questions that future listeners will have as they start to find their way through the real estate space, specifically the syndications and the capital raising and the management. And you were talking about some construction stuff.
Right.
So why don't you tell us a little bit about yourself, how you got started, and then what kind of led you to be focused specifically on this business?
Gotcha. Yeah. So real quick, but important to the story is I was very fortunate to be raised in an entrepreneurial family. My dad owned a employee benefits company. At one point had 50 employees, and one of his largest clients was Advanced Auto Parts that had 30,000 employees. That was one of my dad's clients. So I grew up in an entrepreneurial family, and coming out of college, I thought about going to work for dad. I thought about doing a lot of different things, but I like the financial services business. So I became a financial advisor at 22 years old. Got my Series 6, 63, 65 life and health licenses, and started doing financial advising when I was 23, talking to people 2 and 3 times my age. What I
Wow.
realized, though, Casey, after a couple years, is that most of my really wealthy clients, I was kind of a natural at it. I had no problem cold calling. I had no problem talking to people I had money. I had no problem talking to people who were much older than I was, because of my dad's kind of leadership and mentorship. So, but I noticed that those clients had most of their big money in real estate, Casey.
Yep.
They didn't have all their money in the stock market. So I took notice. These guys own apartment buildings. They own rental portfolios. They own retail strip centers and leased them out to restaurants. And I took notice. And so I bought my first investment property when I was 24 years old. It was a duplex. I knew that I would be a landlord. My mom thought I was nuts to think, number one, I was in real estate, and number two, I was an all commission salesperson, right, with zero salary after this big college education, this big expensive college education. So I already had strike one and strike two as far as my mom was concerned. So I better get the thing right, just to
Yep.
just to make her happy. Um, but fast forward, I saw what they were doing, and so I started buying real estate with my own money. Pretty much paying full price. I didn't know how to get deals off market. I didn't know how to raise private money, but I just went. I just went and started buying properties. I bought
Sure.
duplexes, I bought quads, I did some flips while I was still a financial advisor. Long story short, I got into residential. We did thousands of flips, wholesale, fix and flip. Started a private equity fund in 2014, raising capital. We became a private lender. And then in 2017, really began focusing on our apartment portfolio, the cash flow from apartments. And today we've done 18 syndications and own 4,300 units, primarily in Ohio, Atlanta, and Houston. And so, it's been a very natural, organic growth process, Casey. It's not like I
Sure.
just jumped in day one and made $1 trillion.
Yep.
We were very methodical about doing a couple deals with a full-time job. Then we were methodical about building a real estate business, quitting our jobs. Then we were methodical about raising and building a private equity fund, raising money. Today we're methodical about buying apartments. and doing the construction and raising capital. So it's just been stacking one block on top of the other for a long period of time. You know, people say, Josh, wow, you like an overnight success. I'm like, yeah, overnight success that took me 25 years to get there. So, you know,
Yeah.
that in a 3-minute sort of start, that's kind of where we've been and how we've grown.
Yeah, and that's sort of those are the same kind of people that say, "Man, you're so lucky." I'm like, "Really? Luck? Come on
I've been
now."
stacking blocks, man.
Yeah,
Just stacking
stacking
blocks for
blocks.
25 years.
They don't see the years when those first blocks were so difficult to try to piece together that block, much less the blocks that you stack on top of one another. So,
No doubt.
well, that's awesome, man. So a couple of things that kind of jump out right away. I noticed that you're in three very from the outside looking in, let's say, three very different markets.
Mm-hmm.
As far as demographics, as far obviously geographics, and I know you started in the Cleveland area, correct?
Correct.
So when you start, and I understand, and as somebody that's been around this stuff for a while now, I understand the duplicate the duplication the methods that you just take from, like, you duplicate what you were doing in Cleveland to Atlanta, and then you
Mm-hmm.
duplicate what you're doing in both of those markets to Houston. But there has to be some differences in culture and some other things that took place. But my big question about all of that is what did you look for, and what were the risks involved in saying, hey man, we're doing this really good in Cleveland here, now let's jump into the Atlanta market and
Yeah.
maybe to the Houston market after that? But to me, I think a lot of people feel like that's such a big hurdle because they just don't know those markets, and they're like,
Yeah.
man, what if we get down there and we're buying an asset in a shit location that
Right.
we didn't know was a shit location?
I'll tell you, Casey, it comes down to partnerships and capital. Okay. So I'm a pancreatic cancer survivor. That all happened in 2011, 2012. When I survived cancer, I realized I'd made a huge mistake in that I didn't own a lot of cash flow. I was flipping, I was wholesaling, I was very transactional. So when I was fortunate to survive that disease that has just a 7-8% survival rate, I swore I was going to do it differently. And the way I was going to do it differently was I was going to hang my hat on raising money. I knew that everybody needed money. There were lots of really experienced real estate investors that didn't quite understand how to raise capital and get their hands on capital as much as I did because I was a former financial advisor. I knew what the advisors sold and how they sold it, so I could easily win the argument of raising capital, having investors put their money in real estate versus the stock market. I could win that argument 99 times out of 100. So I hung my hat on what I knew. Like, so that's probably my first piece of advice for your audience is to really figure out what you can do that's different, that's super duper niche. Make yourself an expert at something super duper niche. That was going to be my niche. So I schooled myself, I learned, but I executed on raising money. That reputation of being able to fund all my own deals allowed me to then raise money into this fund. The fund then created this reputation nationally of being able to fund deals as a lender.
Okay.
Then, Casey, my investors came to me and said, hey, Josh, this debt fund, this lending fund is great. We're getting great returns, but what else do you got? And so we were doing all these
We
deals
want
in Cleveland.
more. We want more.
They want more. So it just organically grew, and I listened to the market. I listened to what the market wanted. These investors wanted something else. And so we started talking to some of my buddies in 2014, 15 who were already in apartments that were already operating in these markets, in the Houston market, in the Cleveland market, in the Atlanta market. And we could bring something to the table that they needed, which was the equity, the capital, the downstroke.
Okay.
They needed that money to execute on larger deals. And so we knew our niche. We weren't going to operate the real estate in Houston or Atlanta.
Gotcha.
We have a deal in Oklahoma. We had a deal in Mobile, Alabama. We sold those off, but we weren't going to operate the real estate down there. So it was key to coming to the partnership, for people to raise their hand and say, hey, Josh, I know that you're really good at raising money. I know that you can sponsor loans. You have a big balance sheet, but I didn't want to be flying back and forth to these locations. So I knew locally in Cleveland, we could operate the real estate, do the construction, sponsor the loan, find the deal, and raise the money. We could do it all, and we do. But in these other areas, it was about finding some key partnerships with some people who are really good operators.
Yep.
That's the way that you can scale and get big equity and big deals without having to actually drive, fly, do all these kind of things. So when they brought the deal to us, Casey, they had the deal packaged up and ready to go. The underwriting was done, the due diligence was done, all the reports, the economics, the geographics was all done. I was able to read it, verify it, and then say, yes, this is a deal I want to partner on. That's how we got into these other markets.
Cool. Yeah. And that's it. And one thing that I've learned from doing these podcasts and being around this business in general is because just like you said, you said, well, we got so many doors in Houston, we got so many doors in Atlanta. And a lot of times it's like Paul Harvey used to say, all right, now let's get the rest of the story, which is exactly what you just gave us. The rest of the story is because it's so confusing to an outsider looking in to say, man, how does this guy know what's going on in Denver? I mean, if I stepped in the Denver market, I'd get trashed because I'd pay too much for something because the people
Sure.
so you see what I'm saying? And that's one of the things that I had to learn in this business is because somebody says, hey, I'm a partner on 1,000 doors in Oklahoma City. And I'm like, I've been to Oklahoma City. Okay. And I know that you can get dumped in an area really quick. That's not that has viable living people there, but you definitely don't want to be walking around with a pocket full of cash. Okay. So
Right.
what I'm getting at is, and so with all that being said, yeah, there's always more to the story. And I love the fact that you took your talents and you were like, hey, I know what I can hang my hat on. This is what I can do. Now let's go. When you come to me and say, hey, I got this deal here, all of the little things are done. And now you don't have to worry about changing light bulbs in a unit in Houston, right? You know what I'm
That's right.
saying?
That's
What
right.
about the ongoing property management when you have somebody bring a deal like that where then you raise the money and then you sponsor the loans or whatever the case is, the property management side of things, do you usually like want that to be integrated in with whoever you're working with? I mean, because it just seems like too many hands get in one pot. And that's one of the things that I've always kind of asked about when somebody says, yeah, we're partners on this over here. I mean, what requirements do you have of somebody that looks after those properties in, say, the Atlanta market? Do
Sure.
you want that property management integrated?
Oh, yeah. Well, what I want is third party. I want third party property management. Third party property management with a really good manager. So we've used 4 major property managers. We use Asset Living, we use Trinity Multifamily, we use RHM, which is based out of Cleveland, but they manage in like 16 different states. And then we have one kind of local manager that just manages stuff in Cleveland called REM. And they're all really good. Any property manager, Casey, is going to have their ups and downs. They're going to have their good stuff and
Oh
bad.
yeah.
But in order to be a really good asset manager, a partner and asset manager, there's a couple things that have to go into that. One is you have to make sure that the property manager agrees to manage the building on your projections and pro forma. They want to bring their own pro forma and they want to say, this is what the expenses should be. And this is the different, money that we're going to put into unit turns. And I stop them and say, no, I own the building. This is my business plan. If you can manage to this business plan, you've got the job. If you're going to manage to your business plan, you're not hired or you're fired. That's one of the keys. Secondly, we don't want the property managers to do the construction and the renovations. Most companies are either really good at property management, meaning leasing, marketing, maybe make ready unit turns, but any heavy construction has to be done by a totally separate company. Okay. So in the Cleveland area, we use third party managers. They don't like it, but we manage the hell out of them. Like we're on top of an owner meeting once a week, and we're secret shopping our properties, showing up out of nowhere. We're looking at our P&Ls on a monthly basis and really drilling down on the expenses. So we are a very active ownership group. That's a key to being successful in not only this business, but really any business. Um, and so we want to separate. Okay, so again, one, make sure they manage to your pro forma. Number two, separate construction from property management. Three, secret shop, manage really hard. A lot of guys that I see doing these deals, Casey, and they're based in Cleveland, but they're buying a deal in Colorado, or they're based in Charlotte and they're buying a deal in Florida. They think, hey, I bought the deal, and it's like a license to be a passive owner and let the
Yeah.
property manager just do the property management thing.
Yeah.
That's
Man,
financial
I
suicide.
passive owner, and there and I'm going to be quite truthful. That's probably a weakness of mine is sometimes I become too much of a passive owner, and I'm like,
Mm-hmm.
and you set these numbers up and you get all this stuff and you're like, okay, all you do is go, you're like, okay, if the rents are collected, then this is what's going to look like on the other side of this, and then I'm on to the next thing, right?
Mm-hmm.
Instead of, but being a passive owner, and that is probably one of the biggest mistakes that I made or I'm talking about in my individual career. And I've had to constantly have that in my mind as something that I had to get separated from. I had to get
Mm-hmm.
separated and say, okay, hey, we have to worry about, because I had a guy tell me one time, and this is not specifically to this point, but he said, I asked him, I was like, we were in Kentucky and he had his boat registered in Alabama. I was like, "You got your boat registered in Alabama? What the heck?" And he's like, "Yeah, it's like a third of the price, right? To have
Mm-hmm.
to have your vehicles registered in Alabama and live in Kentucky." And he said, "All you have to do is own a house down there." So I went down there and bought a house. I rent the house out. The house cash flows. I use that address and I register all my vehicles down there because it's about a third of the price. And I said, "What in the why? Why the
Yep.
headache?" And he said, "Man, you take care of the little money, the big money will take care of itself." And it's the same thing where instead of being a passive owner, if you get in there and you start worrying about some of what somebody might consider a nuance expense or a minor expense, and you start hemming some of those minor expenses up and bundling them up, you can really start adding to that profit.
Oh yeah. So I think the key to that, Casey, is secret shopping everybody. um,
That's
Secret
interesting
shopping and walking
concept. Yeah.
units, showing up at random times, walking units, showing up at random times, walking common spaces, showing up at random times, talking to the tenants, the residents, showing up at random times and checking the books, demanding a set of books that you may not get till the end of the month, that you demand and say, close out the books today. I want to see them now. And it's middle of the month, and just shocking the system and say, look, I'm the owner. I want the stuff at the end of the day. I'm not being a prick about it, but secret shopping people keeps them on their toes to know that, hey, man, like you said, take care of the little money. The big money will take care of itself. It's like, again, while the cat's away, the mice will play. That is
Yep.
all true. It's all true. And even with adults, even with super professional people, you have to make sure that you're taking care of your assets. I've seen some guys get in big trouble. And what they've been fortunate in the last 10 years is we've been in a
Yep.
bull market with stocks, crypto, real estate, everything. Well, everybody looks like a superstar.
Yeah. That's right.
Right now, you're going to find out people aren't going to be superstars because the market's not going to bail them out. People have been bailed out by rising prices.
Yep.
They don't know how to operate in a recessionary market, which is what we're about to see. So some guys are going to get clipped real bad coming up in the next 12 to 24 months. And other guys that were managing their properties like crap got bailed out because they were just able to sell the asset for more.
Yep.
So if you're a limited partner or you're going to be a joint venture partner with somebody, make sure you dig on those types of financials before you invest or before you partner, because some people look like superstars, but only because they got bailed out by the market, because they were terrible, Casey, terrible operators. They didn't have their shit in order. Property management wasn't tight. Their construction was loose. They were over budget. They were bleeding cash, and the market bailed them out. So, but they didn't take care of the little money, right? And
That's
so
right.
that to me is where not only do you operate in a good market, in a bull market, but that's how the best operators are going to operate in this bear market, and that's where they're going to win. And on the other side, they're going to have this amazing, I know, are going to have this amazing reputation for how we managed and it's gonna bring in more investors and more deal flow and more opportunity.
Yeah.
So you got to take this business pretty freaking seriously. But the good thing about it is that the deals are big enough that you can have professional management take care of all the leasing. You can have professional contractors do all the unit turns and all the improvements. Professional book work like P&Ls, balance sheets from CPAs and your controller. Professional everything. You just have to be a really good manager of managers.
Yeah.
You have to know what your requirements are and then secret shop. That's the key to being a good operator.
Yeah. And I know there's a very, when I use the statement that take care of the little money, the big money will take care of itself. And they're also, from a management perspective, there has to be a fine line right there between something that is actually frivolous or something that's really not going to make a huge difference, and spending half of a day working on it or figuring it out, when in the end of the day it's going to make $100 difference in whatever. Now,
Mm-hmm.
obviously there has to be a little risk v reward dialogue in there amongst yourself to say, hey, is this worth chasing, or am I crowding enough little money up here on the other side? So that can be detrimental, as it can be equally as detrimental as it can be helpful, because you can waste all your time spending countless hours towards frivolous stuff that doesn't going to make a hill of beans difference, instead of
Right.
just focusing on saying, hey, let's make some movement here. And I think that's where a lot of people are apprehensive about the professional third party management teams.
Mm-hmm.
And I think the other part of that too is, well, there's a couple different aspects, and I've had endless conversations about this private integrated property management versus private professional third party management. And
Mm-hmm.
it seems like it's almost split. Like there's 50% that believe, hey, I want control. Joe Fairless will tell you, I want control. I want my investors to know that we're watching that dollar from the second it walks in the door until it funnels all the way down to their
Mm-hmm.
pocket. And then vice versa. Then there's people like yourself who are saying, no, third party management's the way to go,
And
because
here's why though, Casey. Let me tell you why. You have to hang your hat on something. And if you're going to be really good at something, like our
exactly.
model is not to buy and speculate on, buying something almost full price or overpriced in the path of progress in the Sun Belt and just watching the path of progress make a deal worth more money.
That's
A
right.
lot of people bought on that model over the last 2 to 5 years, just expecting growth, 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 growth. But what they didn't factor in was a lot of the growth was happening because the capital was so cheap, because the Federal Reserve kept interest rates so low.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
So now we've hung our hat on really the opposite. We've hung our hat on forced appreciation through heavy value add construction. So buying
Well, and
this
that's
1960s, yeah,
versus raising rents for forced appreciation.
right. We force the appreciation, not through economic growth, not through population migration, but through having a better product. So we've hung our hat on this model of saying we're going to buy this 1960s and 1990s vintage apartment buildings that have deferred maintenance, that haven't been upgraded, and we're going to, instead of building new in the path of progress or buying something that's pretty much brand new, built in the last 10 or 15, 20 years, we're going to take something that's 50, 60, 70 years old and make it like new for much, much cheaper. Our basis is much lower. So you can't hang your hat on this heavy value add construction and integrate your property management. It's
That's
too
right.
much. In my opinion, it's too much. So we
Well,
thought, look, we're going to make the property management really damn easy by having an amazing looking product, new windows, new exterior paint, ceiling and striping driveways, all new interior units, renovated, all new commons with LED lights, carpet squares, new paint. We're going to make the product new in an area where there maybe isn't a lot of new product. And we're going to stick out like a sore thumb that we have the absolute best product in the market. And we're going to make the property manager's job really damn easy. Yeah. So that's what I mean about being super niche. This is one of these traits of elite entrepreneurs, being super niche and finding what your superpower is. Our superpower is raising capital, and it's in heavy construction, because a lot of other operators, they just want to buy and let the third-party managers run it, and then they don't have a better product. They're just in the middle, and their product looks like all the other product in the market. And they're hoping the population migration, they're hoping the low interest rates help them, and it has. But it's not. They're not really super niche. They're just doing what everybody else is doing. We've found a super niche program for us that works, and we've hung our head on construction instead of property management. So I hope that helps. Like, especially helps your audience think about ways to make money. Super niche is where it's at.
There's an issue that I've had, and I think part of the market, the bullishness of the market has led to some of this stuff taking a little bit of a course that it's taken that I'm not 100% in agreement with. And that is, I've read through in my career, I've probably read through, I'm going to say, maybe it's not this many, maybe 100 different PPMs, just line by line, read through them and figured out, hey, who's done what's this look like? And one thing I've noticed in the last, say, 2 years, with the availability of capital, the increase in the market, the increase in rents and all that stuff, and the ease of this business in general, right? Mm-hmm. Is that a lot of these guys have taken, like they've built all of these terms into their PPM that are heavily weighted to their side. Okay. Mm-hmm. Like so you've got these guys who have, and I know you have the construction management stuff yourself, so I don't mean to necessarily feel like I'm throwing you under the bus on this, but one thing that it basically came down to three things. It came down to the ownership of the property being under one person's control, then that person controlling a property management company and or a construction management company, and basically all of this money being paid, and then to go a step further, their fees are then it says in the PPM, hey, and your company or your investment is going to pay whatever fees my construction company determines, mm-hmm. and you're going to like it.
Yeah.
And the thing that really irks me about that is, and it comes down to a very, very simple point of discussion, and that is alignment of interests. Now, absolutely. I say all of that to bring it all back and tie all these cords together to hold the balloon of this, to say it's very difficult to have an alignment of interests and have your property management company or your construction management company show a profit.
That's right. That's exactly right. I totally agree. Our property manager, we don't own the property manager, but our construction company operates at cost. We operate at cost.
And I think that's very important. But see, what I'm saying is there's probably, I bet there's, I don't even know how many operators, I'm not even going to put a number on it, but there's multiple operators out there right now that have these PPMs that state my construction company is going to charge 10%, 15%, 20%. And you as the investor in this deal, hey, you either like it or you don't.
Right.
Now, how does that, in an alignment of interests, how does that benefit your investors?
Yeah. So we're going to work really hard, Casey, to do the construction, and we're going to do it at cost. Here's the trade-off. What our investors really want is more cash flow. So we try to pay a little bit higher pref return. We're usually somewhere between 8 to 10, and a lot of times it's a 10% pref. So we want to structure the deal where we can cash flow and break even off of existing in-place cash flow. Sometimes that doesn't happen, and we've got to over-raise some money and put some money in the kitty to make sure that we can afford to pay this 10 pref. But because we're working hard and we are really delaying our gratification to later, we take more equity in the deal in exchange for paying them a higher pref, and also in exchange for our construction company operating at cost. So they get what they want, which is a higher immediate cash flow. We get what we want because we're investing for the long term. We get a stabilized product and we keep a little bit more of the equity. So on some of my deals, I own 100% of the equity. We paid our limited partners a 10 pref and then like a 1% bonus or a 1% kicker at the refi or sale. They get no equity. So that's one structure. So I own a number of buildings where me and my two partners own 100% of the property. Okay. Now other buildings, and a lot of them, we tend to keep about 60 to 75% of the equity because my thought is, look, if I'm going to give you a higher pref, which is what you want, my construction company is making no profit, then I want to make sure that we're in alignment here. You're getting what you want. What I want is long-term balance sheet. What I want is long-term equity. What I want is a long-term stabilized asset.
Yeah. I
So
want
most
the
guys
cash
are the
flow
opposite,
later.
as you know, Casey, where they're giving up 70% of the equity to the limited guys, maybe paying the limited guys a 6 or a 7 pref, and then they're feeing them to death. Fee. And like that just turns into an income stream anyway. That's not really even tax advantage to do it that way, but they give up a lot of the equity. So we've gone the opposite route. Again, go back to this being super niche. What's your superpower? This is what we've hung our hat on to be different in the marketplace. And it's worked out really well for us because rents are going up organically. Everybody knows that. But we're getting huge rent pops because our product looks and feels like it's brand new.
Right.
So we could do it the way everybody else is doing it. And I've done deals that way. We've done 18 syndications. I have kind of 4 that are kind of the traditional model. But the other 14, it's really this other model where we're focused on heavy construction and we're keeping a tremendous amount of equity for ourselves.
And I think
that feels like it's in alignment.
Yeah, and there's definitely the idea that once you figure out what's in alignment with everybody and you just kind of stay on that path, but each deal is different. We all know that if you're doing one-off syndications, every deal is going to have different terms because of different nuances in the market or the building or whatever. So, all right, well, listen, we're running out of time here, so I want to ask 2 questions. We got 2 questions, and then we're going to let you get to how our listeners can reach out to you. The first question is, what is the best book that you have either recently read or are currently reading?
So I'm a big fan of Simon Sinek, The Infinite Game. That's a phenomenal book. I'm a big fan of Jocko and all of his books, about
I heard Jocko
ownership.
speak about 2 weeks ago. Man, that guy, if you can't get fired up listening to that dude, you got problems.
And I can't think of the author right now, but the book, Everything is Effed, I'm not going to say the word, is actually a book about hope. If you haven't read it, some people get thrown off by the title. It's actually a book about hope. It's actually a book about confidence. It's actually a book about creating your own path. The title threw me off, but when I read it, went through it, there's actually 2 or 3 in the series. Loved that as well. I think that's Mark Hansen is the author. That's a great one that I just went through. So those are a couple there.
Awesome. All right. What is a dream vacation that you have either taken or hope to take?
Yeah, so I went to Europe for. So my wife is first generation Italian American. Her parents are first generation off the boat, Italy. They still have a house in the mountains in southern Italy, and it was a house they actually lived in during World War II. So the mountainside was bombed during World War II by the Nazis, and they lived there during the war. Well, my wife's father, so my father-in-law, still has the house. We went there for our honeymoon. We met her family. We ate like real authentic local Italian food that was like amazing. The family made it. So and we're gonna go back there next summer. So it was amazing for me to walk in this house half a world away and actually see a picture of my wife in what would have been her bedroom if she still lived in Italy. So that to me is a dream because it's so real, it's so authentic. And it's so family oriented. So we're going to go back to Italy next summer. I'm really looking forward to it.
Awesome. My wife and I we were in northern Italy back about 2 months ago. We flew into Milan and home from Rome. I know my listeners have heard me talk about that trip 1,000 times.
Yeah,
man, it's just Italy, and all in all is just we took the train and through some of those little hillside homes and stuff like that, and so on and so forth. So anyway, all right, I know you've got to get going. So what is the best way for the listeners to reach out and get in touch with you if they've heard something that resonated with them, or maybe they even want to be investors or potentially talk to you about a deal?
Yeah, just our main website, freelandventures.com. There you can find all of our investment opportunities, our YouTube channel, our mastermind that I run, and our bio and our portfolio. It's all at freelandventures.com.
Awesome. All right, Josh, thank you so much for the time that you've spent with us today. And hopefully listeners have gained something out of it. And listeners, by the way, don't forget, remember, I always tell you to go down and find that subscribe button. And I don't care what appendage, finger, elbow, ear, eye, nose, hair, whatever you can take to smash that button, hit it, subscribe to our podcast so you're notified of every new episode that comes out. And please leave us a 5-star review and write a review so that other listeners may know what we talk about here on the Cash Flow Pro. Josh, thank you again so much for your time.
Casey, thanks for having me, man. This was blessed.
I hope everybody has a wonderful rest of the day.
Cash Flow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.